Okay, well, thank you for doing this. I wanted to talk about inflation and deflation. I hesitated to even use that word because I think people are misusing it, but you can set the record straight. So there's a lot of headlines about soft landing, recession. It seems like no matter what the opinion is of the article, the trend is agreed upon. The inflation, the numbers are coming down. So I thought we could do a video to cover what some of these different things mean, what to expect, and the impact on B2B pricing and sales teams, and go through some examples.
Just to set a little bit of context, which is that we had the pandemic, we had issues with supply chain, we had inventory issues with a lot of products, and then we had pent up demand along with incremental cash to spend, right? So all of those created sort of this bubble, and I think what the economists are saying is a lot of that is getting flushed out of our systems now. So it's kind of getting back to a little bit of quote unquote normalcy that's out there. So I think the question really is, what does that mean for a B2B perspective for the clients that we work with? Because obviously we're using these B2C nomenclature as well as events that are happening, and we're trying to kind of pull that back into a B2B context. And I'd love to hear from Pete and Adnan, but from my perspective, it seemed like during the pandemic and during the pandemic and a little bit post-pandemic, people were really worried about that and the supply costs going up, and the question was, how fast can we change prices to keep up with the increase in costs? That was like the big question, right? And there was pockets of clients that were like, hey, let's just use the disguise of costs going up to just raise prices. We typically don't like working with clients like that, so that's not part of our thing. But there were companies that were doing that. Now I feel like our clients are talking to us about, hey, we were able to get a lot out of our pricing the last couple of years. Now we're a little stuck. How do we go get more out of our pricing now that we don't have this sort of environment where demand is really hot as well as costs are going up, so we can use that as a bridge to increase our prices that have been stagnant for many years. So now it's kind of coming back down to the regular conversations of, where's your value? How do your customers, create value? How do you create value for your customers? Where's that going? And how do you get paid for that? So I feel like that's kind of the world that we're in now. But Pete and Adnan, love to get your perspective on where we are.
Go ahead, Pete.
I was going to say, I think a lot of what you're describing, well, a couple things. One is that I think that speed of adjustment is really important, because I think you saw, even with the macro environment changing over the past few years, it wasn't always the case that companies were able to make changes as fast as they expected. And you found this out in your CXO interviews. But I think you see that now. It's almost like a whipsaw effect of some folks were kind of late to the game, or they were surprised they weren't able to adjust as the tide was rising, and they would have to make these bigger jumps that were like more dissonant to their customers because they're big unexpected changes, and that was hard. And then for the folks that are even more laggard than that, now they found themselves having large increases on the supply side, and then they can't pass those along as readily. So I think that's just a dynamic we're seeing, and so the need to be able to understand what's changing and how fast, and how can we therefore adjust in a way that makes sense. I think that works both going up and coming down. And it's interesting too, because just how when you talk about like our 2x2 inflationary or recessionary framework, right? There's always segments of the economy that are going to be kind of in boom, and others that are going to be in recessionary. And I think the same thing goes for inflation and deflation. Whereas I think deflation, I think of it like an economy-wide phenomenon, and we're not there. Clearly, we're still having inflation that's at least 50% above the Fed's target. But there are sectors within the economy that are absolutely coming back down to earth after some really high increases, between goods, services. They're just behaving very differently right now.
Yeah, it's a super interesting conversation. I think partially because this level of volatility is, in many ways unprecedented, where there's this massive uptick for a while, kind of post-pandemic, and now you're seeing that that downturn. And it's without a doubt an ingredient into what goes into pricing. But at the same time, it's not the only ingredient. So, for example, we're working with a client right now, and they're in a position where they have very significant differential value. They're moving ahead with a significant product change that is adding even more value. But the nuance is that they're forecasting that next year is going to be a down market for them. So they're like, well, we're doing a lot of cool things. We're making what we give to our customers even more valuable. Historically, we know that we have been underpriced relative to the value that we have. But going into next year, we know it's going to be a down market. So how do we effectively navigate this in such a way where we can price in a way that is reflective of our value, but the market is decreasing? Because what they don't want to do is go out and have this perception that we're egregiously increasing prices in a market where their services are less value, while also balancing that out with the fact that, hey, there's all these cool new things that we're coming out with. So the point I'm trying to make is that it's one of the many factors that come into play. It's nothing that we would want to gloss over. It is for sure industry specific, but there's all these other factors that come into play. And particularly if there's an increase in value, there's ways to effectively navigate a price increase.
Yeah, it's interesting. Sorry, go ahead, Pete.
You go for it.
I was just going to say really quick that it is, we preach this to our clients a lot, and it just is really important now as well, which is to be able to normalize your data with what's pricing performance versus what's market driven. You really need to look at it from that perspective, because otherwise you're gonna adjust the wrong things. You're gonna make the wrong decisions based on what's driving your profitability. So that driver, the growth drivers, if the market's doing really well for your sector, and you go, hey, these are my prices are perfectly aligned to value, that may not be the case, and you'll feel it when the market starts changing, and vice versa. So Adnan, I think your point is very, very important, because we need to understand pricing and price alignment to value. We need to understand how the market's doing, and we need to put that pricing structure in place that basically talks about what do we do if the market's high or the market's low, or we're stagnant from a growth perspective. That structure becomes really important, because we know from the last few years, one of the things that's important to customers is the sharing of risk. So is your price model built in a way where if the market does go south, it's not like you have to lower your pricing or be misaligned with value? What if your structure is there to share in that risk? What if it's based off of a metric, a price metric that says, hey, if the market's slowing down and my usage slows down, my overall spend will slow down, but my dollar per whatever is not going to change, So when the market does come up, it goes back up again. So the metric conversation becomes really important in sharing of that risk.
Yeah, G, I like that. I was going to add that it sort of reminds me that the time component to how to react to inflation or deflation, whatever the price adjustments are, it's basically now, and it's always now. It's a changing now, just like when you think about preparing for a negotiation in a B2B deal that's a renewal 1 year away, 2 years away. It's always the best practice to talk about value early, right? So that when you get to that negotiation and everyone on the buy side wants to talk about price, you've sort of got some fodder to push back against. But it's very predictable. You can say that, all right, this is a year out, we need to make sure we're doing this. I think with pricing, you don't know exactly where the market's going to go tomorrow. So what the environment is today, it's helpful if you can act quickly, because we're working with a couple manufacturing clients, and in both cases, if you look at allocated cost and material indices, however you want to measure it, multiple ways, they've only been able or only successfully passed through about a quarter of the inflationary pressure that they've experienced. So their cost of service going up both from material and labor side, and their profitability, therefore, it's going down pretty sharply. And to some degree, yes, you can message backwards to say, hey, we're underwater here in these ways, but kind of the ship has sailed. And now when you look to this flattening inflationary environment, you're not going to have the same juice to make an adjustment. And so it's going to be more challenging. And those same customers have kind of felt the inflationary squeeze from every other vendor, so their resistance is going to be pretty high. So, I mean, there's still something you can do, but it's important to set up the infrastructure so you can respond more quickly.
Yeah, timing is everything. If you're coming into the world now trying to increase prices based on some type of a inflation story, I think you're pretty late to this game. You're gonna have a tough time doing it because, like you said, Pete, pretty much every vendor has gone through that journey already.
You know, it's kind of crazy. This obviously is so different because it's from the consumer perspective, but I got an email from my car insurance company. This was one of the places where pricing has gone up like 33%, I think I saw. And this was pretty recently they sent me this, but it was like informing of the price increase and they blamed it on costs. And at the time I was like, all right, everybody's doing that. So whatever. But then I thought it's so weird for insurance to blame costs. And so then I'm like kind of digging around because they're talking like when you look at the next level of the logic, it's like the cost of vehicles, car parts, repairs, all of the other things that happen in that. But I also wonder if part of this takes me back to the choice conversation that we had in the last one, because it's like, I don't want to go switch companies and I don't really have a choice. I just have to accept it and then continue on my kind of pessimistic journey. But I think B2B, that's a place where it's very different, or it could be.
Yeah, I think for some of these, for car insurance, it's probably best practice to shop them every couple of years. And the reason is they don't typically go down; they only go up. So your 33%, which is, by the way, I think it's happening with most companies because. Not to get into a tangent, but the insertion of all these electric cars that are coming in and the cost is going up, the repairs are going up, all these things are going up. So I don't, I think it makes sense that insurance prices are going to go up. But as we get, I'm making this up, but let's say there's self-driving cars in the future and you're going to have less people, less pool of people. So insurance is a portfolio game, right? So if you have less people contributing to the pot, then what happens to the people who are driving, the few people that are still driving? Do their costs go up exponentially? Which could happen definitely. So I think it's going to be an interesting vertical in itself that's out there. But for the short term, at least, and that's a long term conversation. But the short term, I think, Tracy, the demand is still very strong. If I look at all the clients in our portfolio and I look at what's out there, regardless of if you label it as a recession or a deflation or a stagflation, whatever you may want to say, the demand is really strong still. And if the demand is really strong, then man, I think you've got a lot more opportunity to be creative and align that value to your price or price to your value. And this is the right time, to Pete's point, to do it rather than waiting for something else to happen.
Can we talk about some examples of that? Because I guess there's the people that have, to your point, Pete, like people that can kind of get stuck in a price conversation too far down. But if you're in that kind of scenario, can we talk about that a little bit and what you've seen and what's successful and kind of resetting into value?
So yeah, so if you kind of left it too late, basically, so
Yeah.
the best practice and then what to do when you haven't followed it. So I think the first thing to do is you can almost think of this like rolling waves, right? Because it's not typically the case for most businesses that everything's renewing on some 3-year cadence and then all the business in the company is turning over on that same date. So you can always think of it like anything you do now, maybe you won't be able to affect the negotiation that's happening tomorrow, but the one that's happening next month, you can always start to message ahead of time. And that's, inserting value scorecards and improving that messaging so that you're kind of drip feeding all the things you're doing in the account. It could be on a cadence like at the QBR that you communicate those things. You help empower the sales force to talk about those things and probably enter the concept of financial value as well. So it's not just, hey, here's the features, the products, solutions that you're purchasing from us, but here's literally what we're mutually building together to save you cost, to improve your revenue, to mitigate those risks, whether that in an insurance mindset or or otherwise in terms of that risk mitigation. So really, you can always say you can act now and you won't be able to impact every deal equally, but absolutely. And then I suppose for the major deals, you still need to move value to the front of the conversation. You're going to have different buyers that care about different things, and ultimately when you get close to that final renewal date, you're going to have procurement in the mix for sure. So you need to be cognizant to navigate to production, to engineering, to design, to all the other people that think you're great, and make sure they're part of the conversation, because they'll kind of counterbalance that price focused procurement mindset.
That timing piece is interesting, because that's something that we're coming across in multiple engagements right now, where there's the ability to go out there and price in such a way where they clearly have the level of differentiation to justify it. But the nuance folks are trying to balance out is they have a customer base that is loyal to them, and they don't want to risk a decrease in customer satisfaction. So the key is that nobody really likes to pay more for the same thing that they had historically been paying for. So what we're doing is advising and encouraging our clients to say, as you start to think about how you're adding more value to your customers, which they have planned, stay ahead of that. Make sure that you have the ability and the wheels in motion to go out there and communicate that value ahead of time, to Pete's point, so that it's very clear what customers are getting, and then align your price your price changes with that incremental change in value, because that's a really, really good time to start to move yourself in the direction of aligning your price to that value that's out there.
Yeah, the different. I always like the story of aligning that value and price instead of using the economy or the market as a reason to change your price. Because any smart customer is going to come back and go, hey, guess what? I notice the market's on a downswing. So is my price going to change now? Right. And it should be a common conversation that the customer will have with you, or you should expect it if you're using the market as an excuse. Now you can still value align and use the market as your sort of instigation point, but I think the value conversation, like Pete and Adnan both articulated, should be at the forefront of the reasoning why these are made. And I love the incremental value and aligning your price change to that. We've seen with one of the clients, right? I mean, if you're bringing an incremental differential value of 20%, let's say, you can raise your prices above that rate if you're below value initially, So essentially, you're kind of raising your prices at a higher rate than you're contributing to the differential value, because you're misaligned now. Because you're misaligned now, you can raise at a higher rate as you go through these sort of changes to your product or services. All of your changes to products and services are opportunities to value align. Our clients need to be able to see it that way, so they can make the most of that opportunity.
Yeah, that's a great point, because part of what comes into play is, when starting to talk through some of these strategies, one of the questions that can come up is, if we were to raise these prices in what is going to be a down market, and then we start to get more churn into place, customers start to cancel, they get dissatisfied. Yes, that could happen, but if you didn't raise your prices, that churn is likely to come into place in any case, right? So you have to be accepting of the fact that you have a shared risk out there, and your forecast should take into account the impact of the market. But it's really important to be able to disaggregate the impact of price versus the market, so that you are managing your business in the right way. Because the last thing we want anybody to do is to overreact from a price perspective to potential market changes.
Yeah, and I think the other one, and Pete, I'd love to get your thoughts on it, is the quality of revenue, right? The churn. If you're getting a churn out of your price buyers, maybe that's perfectly okay in a downward market, because you can always buy them back the following year when the market's back up, right? So I think the quality of revenue that you get and where that churn is happening is important, along with how best you can get them back, how quickly you can get them back. If it's transactional versus the sales cycle is going to be another 6 years before you get them back. I think those are two important things in looking at this type of change.
Yeah, absolutely. One is, yeah, it may be that those are the customers who are perfectly happy to let churn and go, let them be someone else's problem, for lack of a better word. And then if ever you want them back, those price buyers, basically all you need to do is offer them a penny less and they'll come back. If they're true price buyers. I think what that's particularly true once you apply a cost to serve analysis and you realize that the profitability of perhaps a long tail of price buyers is actually very low. The other interesting thing is, when you think about strategic or targeted price changes versus just blanket increases, this is another reason why, you could look at a margin analysis across, say a long tail of price buyers or low dollar accounts and say, oh, like they're not, there are D customers, they're buying D products, we should absolutely increase their price. But if they're truly price buyers, it might be that they're kind of at the limit. And if you want to hold on to those customers, you may need to be more careful. Whereas if you look at your kind of A customers buying A products or a portfolio of solutions, they may actually already realize the value of the solutions that you deliver. And you might actually have more headroom to change price or kind of realign price to value, because those are the customers that are already voting with their feet and doing more business with you with long-standing relationships. So it's kind of counterintuitive in that way, but that's another one to look at it.
Yeah, the output variable should really be the margin dollars instead of the margin per customer, right?
Right.
Then find those better decisions overall.
Yeah.
All right, maybe
Tracy?
we pause there. I was debating getting into the whole like the different buyers thing, right? Because I would imagine, like, based on what you're saying, Jeet, with like people coming back and saying, all right, well, inflation's down, when are my prices going down? There's probably a lot of mischief that happens in the poker playing in those arenas, which could take us down a whole other thing,
Yeah, that'll be a good conversation to have next time, because I think I think in some of our sectors, we need to get ready for what that communication would look like if customers come back and go, I'm looking for a 20% reduction because I know your suppliers have just, opened up a new factory. Now you've got plenty of supplies, your cost is going down, therefore I want a reduction. I can completely see that happening in some of our clients.
Then what? Exactly. Okay. All right, cool. Get there next time. Oh, thank you,
Thank
guys.
you.
Thank you.
That's good. All right. Bye all.